Sentiment is the name we give to the psychological behavior of traders that is priced into a certain market index or any other asset. Market sentiment is a key basic indicator of short-term future price actions. Although a non-predictive solution, it describes an overview or mood of the market. For example, we can call a continuous upward trend on an asset as bullish, to indicate that participants in the market are buying the asset since they believe it will continue to be profitable. A bearish sentiment is flagged when a certain asset declines steadily and investors are negative on the future outlook. Sentiment is not always driven by fundamentals such as inflation or GDP readings, although critical fundamentals do usually affect investor sentiment and cause certain patterns in price action. Take the Fed's Janet Yellen speech on rate hikes Friday, May 27, 2016. The positive Fed outlook on a rate hike increased investor sentiment towards dollar-based assets and major U.S. indexes. You can clearly see the effect of sentiment on the S&P 500 as well as on the USDX index. It is very important to understand that sentiment is priced into the market. For example, say a certain asset report is issued with negative data, but as a trader you notice no price action occurring. Convergence or flat trading is dominant in the chart. This means that the market sentiment is against the negative report or is playing low for that asset, meaning investors aren't looking at it as an opportunity. Market sentiment is mainly important for short to mid-term traders and technical traders who need to understand intraday movements. The first question traders should ask themselves when beginning a trading day, starting a new trading hour, picking an asset, or deciding on a strategy is this: what is the current sentiment on my asset? The bottom line before deciding on a trading strategy is to determine if the sentiment is bullish, bearish, or neutral. Sentiment works because of the nature of trading. If everyone buys an iPhone, people without an iPhone will assume it is very good and will also run for the hill to get theirs. iPhone prices will then rise due to an increase in demand that was caused by the sentiment. Many times, price action isn't driven by any fundamental driver, but it does present heavy gains or losses. Price action may still be positive on sentiment. The only problem with this is that you, as the trader, don't know the reason for the sentiment. A lot of fake sentiment can be found on small cap stocks due to insider trading or major investors changing their strategies. It can also result from major hedging actions and institutional repositioning in line with new data findings or macro events. Common sentiment indicators that are released regularly for state economies include the consumer sentiment, which is a survey based on the sentiment of consumers in a given economy towards spending. Business sentiment is similar, only businesses are surveyed on the current conditions for doing business. Investor sentiment is another index to look at which monitors the sentiment of investors towards the market and their general will to invest in any given time. The VIX, Volatility Index, is not really a sentiment index, but rather a direct screener of market stability as it follows trading volumes. Always remember that sentiment is essentially psychological, and the general daily trading weather can be affected by actual heat waves making people drowsier or natural disasters that cause panic. Any key national or international event, like war or a US recession, will affect investor sentiment. Finally, remember this: sentiment is the reason markets are risky, since human behavior cannot be modeled or predicted efficiently. You cannot assume that all investors are rational, but you should assume that a large percentage of them are, and most will go where money can be made with lower risk.